This is David Ranson. Welcome to our webcast for May 2024 for clients. And the topic of this particular webcast is the stock market and its relationship to the economy. There's always something new to learn about this. Although I'm not personally a big believer in the possibility of anticipating the stock market or forecasting it, I do think that it's well worth explaining it from the point of view of how the economy behaved at the time the market was performing. And to my surprise, there is an element of forecastability that came up as we did this. What I'd like to do now is show you a whole series of slides putting thoughts together, first of all about the long-run performance of the stock market, and then the short run, by which I mean a 1-year horizon or maybe 2 at the most. So we go on to the first slide, which is the long-term forecast, the long-term behavior of the stock market measured over 10-year intervals. So this approaches or faces the widespread philosophy that the stock market is pretty safe in the long run, however volatile it is in the short. So you have the slogan, stocks for the long haul. But if you actually plot the behavior, the performance of the stock market over 10-year periods, and you look at overlapping 10-year periods, going all the way back to the 1925 in this case, so the first decade runs from 25 to 35, you see an amazingly volatile result. There's nothing stable or predictable about this. It's about as unstable as the short-term behavior of the stock market is, and this demands an explanation. The second slide shows how it's related to the growth rate. Most people would assume, as I did when I first did this work, that the decades in which the growth rate of the economy was highest might very well tend to be the decades in which stock market performance was highest. That did not turn out to be true at all. As you see, there is a strange relationship, a curvilinear one, if we divide the history of the 10-year stock market performances into categories according to whether they were high or low. What I've done in this graph is to do it in reverse. I've divided the GDP growth rate into categories over 10-year periods, overlapping categories, overlapping 10-year periods, and I look to see what on the average the stock market did in each of these 6 categories. And you don't see a consistent relationship at all with growth. In fact, the best stock market performance is obtained when growth is middling, somewhere in the middle, rather than when it's unusually high or unusually low. There is a meaning to this. One good interpretation would be that a low growth rate over a decade is a sign of instability, and a high growth rate over a decade is also a sign of instability. So the stock market appears to be pricing stability versus instability. And when you have the growth rate in the middle area, averaging 3.4% in the third bar on this graph, that's when we get the highest stock market performance, as you see. That's one interpretation. There could be others. What does forecast the stock market? What does explain why it's so high, its performance is so good in some decades and so poor in others, is much more the inflation rate than the growth rate. It's not a perfect relationship. If you divide the inflation rates into decades, overlapping decades, and divide these decades into categories, the lowest inflation is on the right, the highest inflation is on the left, you see an inverse relationship. On the whole, the bars on the left are associated with poorer stock market performance than the bars on the right. But of course, it doesn't look like a very good relationship. What I found was that if I go back a step into the origin of inflation, or the commodity market that best anticipates inflation, which is the market for gold, then I do get a much stronger correlation on a decadal basis. And that's shown, we published this in the report on this topic a while ago. Here you do see that the decades in which the gold price had the weakest performance, that is a decline in the gold price over a 10-year period, that's in the right bar, those are the ones in which the stock market produced the highest return. And there's a consistent relationship between the gold price performance and the stock price performance, highly inverse. So the best stock market, the worst stock market performance is when we have the highest gold price increase. And that, of course, implies not good things for the present situation. We've had a rise in the price of gold over the recent year, and there's lots of evidence that the price of gold is going to be rising further, which I'll perhaps talk about later. So the price of gold is the best predictor of the stock market, or it's not really a predictor but an explainer of the stock market from a long-term point of view. The short-term point of view is quite different. In the short term, a 1-year plus horizon, as most people would accept, there's a good relationship between the growth of the economy and the stock market. This is a graph that we put together some years ago to divide the primary asset classes into 4 primary assets, and then draw a kind of a map to anticipate how well each asset would perform under particular conditions. And the conditions, obviously we have to put the gold price in here, and along the horizontal axis we're looking here at the change in the gold price, negative on the left and positive on the right. It's the forward gold price that we use. If there may be time to talk about why it's different from the spot price of gold. And here you see on the horizontal axis, therefore, is the inflation variable, the best forecaster from the commodity markets or any other source that I know of for forecasting inflation. On the vertical axis, we have risk. Risk dominates the behavior of asset classes in the short run because some asset classes are safe havens. Gold is one of those. Treasury bonds is another. And so the vertical axis is the change in the corporate credit spreads, which is a very long-standing indicator of credit risk and risk in general. So near the top of the graph, you have a widening of credit spreads, which is good for safe haven investments because it means higher risk, but it's bad for risky investments. Stocks as an asset class appear in the southwest quadrant of the graph, and it can be used as a map. So if the coordinates of the map find ourselves in the southwest quadrant, then we will be anticipating a very good stock market. But they don't appear there currently. As you see, the coordinates as they are today, indicated by the red box and the point with a red circle around it, that's where we are today on the map, and that appears in the southeast quadrant. That is associated with high performance for real assets, hard assets such as commodities, as opposed to paper assets such as stocks and bonds. The northeast quadrant, we have precious metals. The northwest quadrant, we have treasury and other high-grade bonds. So those are the 4 primary asset classes. And most of the time, as the blue blobs on the graph show, the coordinates that we find ourselves in or at lie within the ellipse or the blue-colored ellipse in the middle of the graph. Now, dead center in the graph would mean complete neutrality, where it's not possible to anticipate any asset behaving better than any other asset. And the ellipse is an area of low confidence, 1 standard deviation. So most of the time, more than 50% of the time, historically, we found ourselves with low confidence. But this is one of those occasions when we have high confidence, because we're twice as far from the middle. The blob that corresponds to the current situation is twice as far from the middle of the graph as the edge of the ellipse. Moving to the history of the stock market as a function of the economy, not so much from the point of view of forecasting, but from the point of view of explaining. Here is we can divide the behavior of the growth of real GDP into periods of 2 years historically, and this graph goes all the way back to the end of the Second World War. So we have a lot of data to tell us that when we get a high growth rate of GDP in the current year and in the coming year, then we get a high performance in the stock market in the left-hand bar, and the opposite in the right-hand bar. So growth does play a clear role, although the stock market anticipates the growth rather better than the growth anticipates the stock market, as you might well expect. Now, inflation, we would expect to see a strong relationship here too, because it's the relationship that dominates the long haul, the 10-year time frame. Well, indeed, we have a strong correlation with inflation. Dividing inflation into categories, years in which we had low or high or middling inflation, we get a strong relationship. It's an inverse relationship with the performance of the S&P 500. There is a time lag here. There's some sign that the inflation rate can anticipate the stock market's reaction. So this is quite different from the growth rate example that in the previous slide. We have a little bit of sign, a sign that we have predictability 1 year ahead, because these bars are classified according to what the inflation rate had been the year before, whereas the size of the bars, the tallness of the bars, shows the stock market return from the current year. So we have two factors that would explain stock market performance most of the time. They aren't enough, of course. This is greatly oversimplified. The question is, what would be a third factor that would be worth looking at in the same way to complete the picture, or to get much closer to a complete picture? And it's not a place where most people look. But in the next chart, of course, as you may not be surprised to hear, the price of oil plays a role. And here too, there's some predictability. We have years in which the oil price rose a lot on the left, or even declined on the right, and rose intermediately or changed only a small amount in the middle. And we see here an inverse relationship. The lower the oil price goes, the better the outlook is for the stock market. And there is some predictability because there's a 1 year lag built into this graph. Why would that be? Well, although oil is not considered to be a macro variable by everybody, it really is, because the price of energy, the price of oil dominates the price of energy across all of the oil products and other energy products. They're very important in determining the cost or the cost function for businesses in every conceivable industry. So if the price of oil goes down, pulling energy prices with it, that pulls costs down and makes business more profitable in every industry across the whole economy and across the world, not just in the United States. So there should be an inverse relationship. If the stock market prices that reduction in costs, it would be very favorable for the stock market, and we should get an inverse relationship, and we do. And this is what it looks like. It's pretty strong statistically, just as it was with inflation as well. To see the effect of rising or falling oil prices in the short run, I drew this graph. I classified oil price movements into large declines at the top and large, or least, the smallest declines, or the advances in the oil price and the smallest declines in the bottom, and then there's a middle category as well. And we see, but it's only temporary, the oil price decline is very favorable for the stock market's performance. If you compare where the lines come out after a 2-year time frame, that is, it's really a 1-year time frame after the initial oil price change. So this is another picture of this relationship with the oil price. But notice that it is temporary. It goes away after another year passes. And why would that be? I would argue the natural interpretation would be competition. That competition among companies will dissipate the profits that they get initially from the cutting of their costs thanks to a lower oil price. And as the competition brings prices down, mitigating the inflation rate in the process, then the stock market advantage, the profit advantage, goes away. So one way to look at the stock market from the point of view of oil recently is to see how inversely they're related, and it's pretty obvious even in the last 2 years that there is an inverse relationship going on. And that's shown in this slide number 10. In slide 11, again, I'm classifying the history into 4 possible categories according to 2 variables. Growth can be above average, growth can be below average. The oil price could be rising or falling, or have risen and have fallen, and you get these 4 scenarios as a result of the 2 variables, the 2 inputs. So the best conditions for a rise in the stock market would be above average growth and oil prices, and a decline in oil prices. And we see there the average stock market result for those years, historically, going back again to the Second World War, is 20%. The worst situation for the stock market is where growth is below average, which has been the case on the whole, despite some good quarters last year, and oil prices rose. Well, oil prices have risen a little bit this year. I'll say more about that. But those are the worst conditions, where oil prices have risen over the past year and the growth rate is below average. So the current situation isn't in either of the 2 extreme cases, then the 2 scenarios on the left and the right. It's in the middle somewhere. But we're moving, as I will argue, from a lower oil price to a higher oil price, and that will push us from the second bar to the third bar. That would mean a mitigation, a reduction in the performance of the stock market, which has been excellent going into the future. It has been a puzzle because growth has been below average and inflation has been very stubborn, and yet the market has done very well. So those 2 factors by themselves aren't enough to explain, especially 2023's stock market. But if you add the oil price factor, then you have a large part of the explanation, because oil prices were terrifically depressed. And I would like to say more about the depression of oil prices and where that came from. Here is a long-term picture of the price of oil. One of my major concepts or measures or theses is that in order to understand the present and the future, we have to have a very good understanding of the past, and the understanding of the past needs to go back very far into the past, much further back into the past than most people in the investment community and the analytical community tend to go. And it is a lot of work to collect all the data necessary for this. But here is a graph showing back almost a century for the price of West Texas Intermediate oil. And I've included the price of gold on the graph, and that's the brown line. and the forward price of gold 20 years out is in the red line. And you see parallels between all three lines, but the best parallel is between the oil price and the 20-year forward gold price. So what we have here is an astonishingly permanent, stable relationship between these commodities. The spread between, say, the red line and the blue line or the black line on this graph corresponds to the ratio between the price of oil or the price of gold, the ratio between them, because it's a logarithmic scale, a ratio scale. So what the graph tells us is that that ratio tended to average almost the same in the 1930s as it has averaged in the last decade as well. It isn't exactly the same, there are variations over time, but on the average it's extraordinary how constant it is. And that is an important insight into commodity price behavior, and because these commodity prices are very closely connected with both inflation and the stock market, it's very important to recognize this. So one of the things I've done is to look at the oil price and split it into two components. If the ratio between oil prices and forward gold tends to go back to the same long-term average, then when we have a short-term movement, there are two sources. One source for such a movement might be that the ratio between oil and forward gold changes. The other source of movement is that the forward gold price itself changes. And the forward gold price, as you may well know, certainly the spot gold price is an indicator of the forward gold price. They've been up quite a lot recently. So we have a ratio that is staying low currently, the ratio between oil and gold, or even going down, whereas the gold price is going up. Well, if you look historically, again, going back very far, we can go back beyond the Second World War all the way to 1932. I have the data to do that. And again, we divide the history into four scenarios, and they're described underneath all these four bars. We see a pretty strong inverse relationship. The following year performance of the stock market is related to the gold price change, as well as the change in the ratio between oil and gold. So this gives us a rather primitive model for anticipating the stock market, and it has some value. Although I'm not, as I said, I'm not a believer in forecasting the stock market, but there is some possibility of anticipating or detecting the difference between a very strong stock market and a weak stock market from data of this kind. And if we were to do this with a formula of that kind, we can see about 12 months ahead. And this was plotted recently. I'm looking to see what the date is. I think it was back in February that we plotted this graph, and it shows there is a historic correlation between the formula, primitively based on oil and gold prices, and the actual performance of the stock market over a 12-month interval. They are related. I'm not going to suggest that they should be tightly correlated, but they are related. The correlation is definitely positive. And we can see a year ahead. So the blue line shows the earlier estimates up to the present, the current estimate being about 10 or 12. That would be our estimate, give or take a wide standard deviation of the likely performance of the stock market over the next year. The next chart, number 15, shows some of the same data going back several more years. We can do a scatter plot. On the vertical axis, we can show the change in the oil to gold ratio, and that is allowing for a one-year lag to look at the stock market result. On the horizontal axis, we look at the change in the 20-year or forward gold price, and that too is an anticipator of the stock market a year ahead. And then each of these little squares in the graph is labeled according to what actually did happen to the stock market that year. All these data are averages for calendar years, so I'm wiping out a lot of the random variation in order to see a clear, simpler picture. And although we're obviously missing out a huge number of variables that affect the stock market, nevertheless, these two simple commodity price variables do explain a good part of what happened. In the northeast corner, we tend to get the poorer stock market results because those are cases where oil is up relative to gold, and also gold itself is up. In the southwest corner, we haven't had any instances of being there in the last few years, but the further you go towards the southwest of the graph, either towards the south or towards the west, the bigger the stock market result is. So it's pretty clear year by year that the stock market is related to these two variables. And we can use this again as a kind of a map. We can figure out what the change in the gold ratio, oil to gold ratio has been over the past 12 months. And this is plotted as of April, the end of April, and what the forward gold price increase has been over the last 12 months. These are large numbers. So the forward gold price is up about 40%, and the oil to gold ratio is down about 20%. And you see that position, the coordinates of those two coordinates fit where the star is shown, and that it is implicitly a way to anticipate what kind of a market we may have in the next year, ignoring all the other variables which might affect the market. And if you see the northeast corner as the worst place to be and the southwest corner as the best place to be, this is clearly in the middle. So the forecast implied by the graph would be for a pretty average behavior in the market, less than we enjoyed last year in the coming year. And that's where I'm going to bring it to an end. And I look forward to another webcast in a quarter, 3 months from now. And there may be quite a lot of changes between now and then. And I hope to be able to present new ideas at that time. So thank you for attending.